Hi, as you know, my name is Brian from MoneyWise with Brian, affiliated with Lawsons. So today we're just going to talk a little bit about life cover. So, life cover. It's a very important thing if in our whole wealth planning and wealth management is life cover. It's important to protect your business and it's important to protect your family. So if there was in the case of a sudden death, that the family is provided for, that your business is catered for. So what do people consider life cover? Well, they want to make sure that their spouse, their children will continue to live at the same level that they've been living up to now for the rest of their lives. That they're not going to be put into a position where they're now going to have to, the spouse has to go rush out and try and get work or try and find money where there isn't, and still to continue to provide education for their children, put food on the table, and continue to live the life they've been living all along. So what are the different types of life cover? So you get obviously the whole life cover, and that one I'll go into a little bit more detail in a moment. So there's whole life cover. Then there's a decreasing life cover, so that is also used for a specific reason. And then there is a term life cover. So let's have it. So if it's a decreasing life cover, this is where a person would take out life cover specifically for a debt, be it a mortgage or a bond, and that mortgage or bond will decrease over a 15-year term, and so the cover will just cover exactly whatever that particular loan is at a particular time. So as it decreases, so does the life cover decrease with it at the same time. So that's what. So there's a specific need for that particular. So you might have enough capital, you've got enough, but you just want to cover the actual loan, and that loan will be a substantial amount. It starts off at $200,000 or $500,000 or $1 million, and it decreases over the years, and so does the life cover. Or you have a set life cover, and you know, at the age of 60, when you retire, you're going to have sufficient funds to be able to look after yourself and your family. If you passed away after the age of 65 years old, that your family will be fine because there's this wonderful provision of pension. However, so let's carry on with that thought. So you provide up until the age of 65, term cover. So it stops at the age of 65. You've paid for it. It ends at 65. There's no cash value to it. You've paid a certain premium on a monthly basis, and you've had life cover from the time you started, and it ends at the age of 65 because you know you have enough pension. So they call that term cover. There's a set term for it. Then there's whole life cover. That cover never stops. You will continue to pay for it throughout the term until you pass away. When you pass away, the payment stops, and the life cover will then pay out to whoever the beneficiaries are. It could always be business partner to business partner as well. It can be used for as well, but it will continue from the day that it starts right until the end. So those are the different ones that you have. And then there's another one, also a whole life cover, which you pay on for a 10 or 15-year term. You then stop paying it, but however, your life cover will continue right until you pass away. So you only pay for a certain term, but your life cover extends till the end that you'd actually pass away. That one I'll go into a little bit more detail, as I said. So how do these actual different covers work then? So So in principle, as I said, your depreciating life cover will cover you depending on whatever that particular value of a debt that you have, and that's it. It's as simple as that. It just covers your debt, whatever the debt is. So you take out a 200,000 loan, or you take out a mortgage loan, and your loan is covered by the insurance. The insurance pays out the bank and or wherever you loan the money from, and they settle the debt. And your spouse or your beneficiaries don't have any debt any further, and the loan is paid, whether it be for a property or whatever it might be. Otherwise, if you have a term cover, you'll pay on a monthly basis. Normally that payment increases on an annual basis, so every year it increases your payment and continually grows. And eventually at the age of 60 or 65, you choose to stop, and it then stops, and whatever payment you've made, be it $100,000, all of that money is paid towards the risk, and there's no balance whatsoever. Then, of course, there's the whole life cover, which I said I could mention a little bit more, and I want to talk a little bit about that. And that's the one where you set out to pay for a certain term. And all along that term, there is gathering a cash value to it. So that's the one I want to speak to you a little bit more about for this moment. So clearly all the life covers are not the same. So which one should you really choose then? Well, the one that fits your need. Like I said, you could have the different needs, whether it be debt, whether you want to cover yourself for the entirety of your life. It all depends on what your need is and what sort of funds you have available to contribute to it. So that's always needs to be a discussion that we have. So it's more about what is your current need. So what currencies are your life cover offered in? Well, it can be done in all the currencies. It can be anything from Australian dollars to US dollars. You can really do it in most currencies. Generally, it's done with all the hard currencies, though, and pounds and in euro, etc. Well, what does it typically cost? Well, it'll always depend, obviously, on your age. It'll depend on your qualifications, whether you smoke or don't smoke. It'll depend on what your earnings is. So there's quite a various different amount of factors that's going to influence what it's going to actually cost. So to give you an example of the exact example of what it's going to cost is very difficult. But I did an example for someone the other day. The lady's around about, it's a lady, she's fairly well qualified. She's about 34 years old, and it cost her around about $120,000 that she would contribute over the period of 15 years. And at the end of that 15 years, her cash value would be $150,000. So literally she contributed towards this over a 15-year term, and at the end of the 15-year term, her cash value portion actually built up to be the same amount of money that she paid in. And so typically this life cover paid for itself over a 15-year period. And while she was doing that, she had $1 million life cover. So a great opportunity. There's the other option where you pay a lot less to start off with, but in the end you contribute for the same amount of cover. She would have contributed around about $75,000 to $80,000, a lot less over, but that was going to be over the same period of time. However, there's never a cash value, and if she gets to the end of that 15-year term and decides that she's not going to continue that policy, there is no cash value to walk away from. So you're always contributing towards it. If you stop, it's gone. Whereas the other one, you've contributed, you've got the cash value, which is the same amount that what you contributed, and your life cover continues throughout until you pass away. So this lady's 50 years old. She would have paid for her life cover, just under 50 actually. She would have paid for her life cover. She's not paying for her life cover any further for the next 20 years. But she still has the 1 million life cover intact and never another contribution after the age of 50 years old in her particular case. So that's a wonderful opportunity, and makes it really a cost-effective way of doing it. When should I begin the life cover? Well, it is typically the sooner you start, the cheaper it is going to be. If you're going to wait until you're 50 or 60 years old, then it can become extremely expensive. So the sooner you start with it, you say, but I'm not married yet. If you're 20 years old and you start and you're finding out that it's so little, you're going to realize that it's the best place to start. So the sooner you start, the actual better. Who generally is my client? Well, everyone that is going to pass away. So that'll be you. We're all going to pass away sometime, and we're all going to need to be able to provide for our families, for our spouse, for our children, and to make sure that they continue to live a great life after we've moved on. So yes, everyone is my client in particular. What's my final piece of advice? Well, that would be that you take the opportunity to sit down with myself and have a talk, and let's see what it is that you might need, and see if I can be of assistance to you. I look forward to chatting to you. So that's my piece of advice to you, is let's have an evaluation. It is completely free. Have an evaluation. I give you a final quote. You have a look at it and decide if this is what you would like to do to start and make sure that you can provide for you comfortably for your family in the case of something that will eventually happen somewhere in our lives. So let's try and do it the cost-effective way, and we can look at the various different options that are available. Thank you for your time, and look forward to chatting soon.